I think we should just get started. We'll begin, and I just want to, by way of just giving a little bit of housekeeping, to ask you to mute your mics. Not you, Jeff. You please stay on, and I'm going to actually, I'll make you a co-host so you'll be able to share your screen, and we appreciate you taking the time too. Also, if you have questions for me or for Jeffrey during the presentation, please use the chat feature at the bottom or maybe at the top, and just type in your question and I'll read them so that everyone can hear exactly what's going on. And also, please just stay logged on until the end of the presentation, because we're going to update you on our July educational event, which I'm very excited, and such also a very important topic. You won't want to miss that. So again, thank you so much for taking the time from your home or your home office, wherever you might be, to log in and to kind of participate in this educational session. You know, the global pandemic has really changed so much what we do, how we interact, how we socialize, how we work, how we eat, how we shop. There's such great change, and this the shutdown has resulted in this recession that we're just entering, and there's just so much uncertainty surrounding it because we've got a virus, and the virus is actually controlling how things will be determined. The federal government has thrown trillions of dollars of stimulus. The Fed has done its part, and the markets are just somewhat disconnected to the reality, but we'll defer to Jeffrey's interpretation of why the market is where it is and what's going on in a minute. So with all this uncertainty, how do you make sense of it? What is it that we can do? Because it's things that somewhat are beyond our control, but the reality is that we have to address things in order to make decisions about our own financial security, our own well-being. And as a financial planner, what I do is I help my clients with planning, financial planning, for goodness sake. Isn't that something? So financial planning is really navigating these twists and turns that we're experiencing, and making sure that you have cash reserves, making sure that your investment portfolio is well diversified and balanced, making sure that your goals are in sight and clearly on your way to achieve it regardless of market conditions. So the question, I've got so many questions for Jeffrey. I want to introduce Jeffrey because, you know, he worked at a firm called LPL, which has a big office here in San Diego for 7 years. And he's coming up on his 6th year anniversary at Charles Schwab. And there are 3 faces, if you will, besides Charles Schwab, that really dominate the airwaves when it comes to presence by Charles Schwab and Company. Liz Ann Saunders is the spokesperson for equities, so for stocks, and she's very knowledgeable about that. Kathy Jones is excellent and talks about fixed income. You may have seen and heard them on, on television programs, all of them essentially. But then there's Jeffrey Kleintop. And Jeffrey is unique in that his domain, his perspective is global. So he has to both do domestic, international, and fixed income. So he truly has the bigger picture in mind. And so I'm excited to introduce Jeffrey. And thank you again for taking the time. I'm going to now toggle over to make you a co-host. And then we will proceed, and then about a half an hour's time, we'll see if there are any questions. If there aren't any, I've got plenty for you. And then we'll summarize it and then call it a day. How about that?
That sounds fantastic. Thanks so much for that setup. Really well done, I think, in capturing everything that's going on, the rapid pace of change, why maybe the markets are behaving the way they are, even in the context of the economic data, at least something we'll talk about. And then the importance of planning really came through. You know, this is why you have a plan, right? You don't need a plan if markets go up all the time. It's when we're thrown these curveballs by the market that the value of a plan really shines through. And so I want to talk to you about planning and talking about, you know, what are the market's plans in the second half of this year and next year, and what are the trends we're seeing in place. It's a uniquely difficult time to make forecasts. Not that forecasting is ever particularly easy, but right now with so much changing, even on a daily basis, making longer term forecasts is hard. So what I want to share with you is a lot of trends that I see shifting in the marketplace and how the market's reacting to that and what that might mean longer term. Any of these trends could change, but I think they're well established, and they're things that I think many investors are missing. And I think there are some risks here that investors are maybe overlooking in their portfolios and their plans, and an equal number of opportunities. So I want to talk about how we actually make sense of all this in terms of how we plan for the future. So let me start by actually sharing some slides, some materials I put together that I think will help us understand all this a little better. Pictures, I think, are often worth a lot when it comes to understanding these things. So let me share my screen here with all of you. And hopefully you can see this. I know there's often a little lag. Hopefully you can see that little title card there that shows a global market outlook. Not a very exciting title, but there's a lot of exciting things in it. And I'm going to start by taking a little trip back in time, because I think if we want to understand the trends that are shaping the market right now, we've got to understand where they came from. And that's going to take me here. It's the only look back I have in this whole deck, but I think it's an important one. And this is a chart that I used a lot last year. It featured very prominently in my outlook for 2020 that Lizanne Saunders and Kathy Jones and I published at the end of last year, in December of last year. And this blue line is a leading index for the global economy, put out by the OECD, the Organization for Economic Cooperation and Development. It's a think tank that's been around a very long time. It's a 50-year chart. Whenever this blue line is going up above 100, the global economy is accelerating. And whenever it's below 100, the global economy is slowing down. And that's what we saw late last year. If you look out there to the 2019, kind of near the end of this thing, it was fading and had fallen below 100 and was falling towards 99, that line I drew a threshold on. Because for me, 99 is the most important level of this index. We've never broken down through 99 and not entered into one of those gray columns that are global recessions, where we're losing jobs and profits are falling and stocks have fallen anywhere from 20 to 50%. Bad times. And I was worried that's where we were headed late last year. We saw this slide. The global economy was weakening and slowing down. And as a matter of fact, in the fourth quarter of last year, Germany, France, Italy, and the UK were all either in a recession. They already had negative GDP in the fourth quarter, or were about to enter one. I'd throw Canada in there too, which had a zero GDP in the fourth quarter of last year. So already there was a lot of vulnerability before the virus even struck. And I think people forget that. The global economy was weakening. Even US profit growth, US corporate profit growth was zero, had slowed all the way to the flat line as we got into the third and fourth quarters of last year. So we're definitely vulnerable to a shock. Now, we were thinking that trade policy might be that shock. Didn't see a virus coming out of the blue and causing that shock. But the global economy was vulnerable to whatever the shock was going to be. And it turned out to be this devastating virus. So that's the look back. You can see obviously what happened on this chart. The blue line plunged, and sure enough, we've entered into another global recession. But the good news is it might already be over. But before I get to that, let's talk about some of the ramifications here. So if you take a look at this chart, it's looking at one of my favorite indexes, the Purchasing Managers Index, which is done for pretty much every country of the world. And it's a survey of purchasing managers at businesses. They're the first ones to see trends because they have to order new supplies when orders come in. Surveys have been going on for decades, and this shows the decline in that index, which is measured across the bottom, the number of points of the decline, was related to how dramatically that economy locked itself down in response to the virus crisis. The more stringent the lockdown, and that's measured by Oxford University Stringency Index, where they look at all kinds of things. How aggressive were the school shutdowns? How broad were they businesses? How aggressive were the curfews? All these types of things filter into a number there. And of course, the higher the number, the more stringent the lockdown. And then across the bottom, the higher the number, the more painful the economic hit. And we can see those economies that had the most stringent lockdowns, like Italy, France, and Spain, were nailed the hardest. Countries that didn't implement lockdowns, like Sweden, or even the US, which some states did, some states didn't, weren't hit quite as aggressively. Well, then the opposite occurred, right? So that was the impact all the way through April. Once we got to the peak of the crisis, the peak of the lockdowns, and the peak of the recession in April, things have begun to rebound. This was the first month of that rebound in May. And you can see it's the opposite. The biggest rebound was seen in Italy, France, and Spain as they unlocked their economies. Not as much in Sweden or even the US as we kind of move through the end of that crisis. And as a matter of fact, we've now got preliminary data for one more month, for June, which just came out for just a handful of these countries, notably France and Italy and Spain, and the rebound's now complete. France's recovery is now entirely 100% back to where they were before the virus hit, going back to January or February. Now, those weren't exactly great times, I remind you, back to the first chart. Much of the global economy was on the edge of recession back then, but they have fully recovered from that virus hit. Whether that's sustainable, well, that's what we've got to look to next. And so we are looking on a weekly basis at a lot of indicators to try and make that assessment. We can look at the monthly or quarterly economic data, but frankly, it's just too lagged. We'll miss the turning point. So we focused on weekly data points and ones we can independently verify across a number of countries. And we mapped them sort of heat style here, where red is bad and green is good. I'm going to start with China here. I'm going to quickly take you through a number of countries. But I want to start with China because it's the country that was hit by COVID-19 first and didn't handle it well up front, right? Did a cover up, had a number of problems, then locked down a province, and then since then really aggressively moved to contain the virus and has had a zero tolerance policy since then. You can see here where all the red shows up right after the Chinese New Year holiday began, where they really started the lockdowns right at the end of January. All the red started entering the picture in terms of new COVID cases really spiking up there on that top line, the government stringency index in terms of the lockdowns across that economy, and then all the economic data below it. Let me explain what we're looking at here. Air pollution. Air pollution is not a good thing, but it is a proxy for manufacturing activity. NO2 emissions are a good measure of how much manufacturing activity is taking place. When you think of a factory in your head, you think of smokestacks and you think of stuff coming out of them. And sure enough, that's a pretty good real-time measure because it dissipates fairly quickly of what manufacturing activity looks like. And you can see how that really slowed down in January all the way into the early part of March. China, which is a big manufacturing economy, really put the brakes on there. Their air quality cleared up. You could actually see across Beijing for the first time in a long time, but it really meant that they were shut down. The next thing is weakened box office revenue. Look, I want to measure how quickly we as a people are willing to gather together in groups for entertainment. We've only started to see cinemas around the world begin to open up. Not much yet in terms of China. Again, zero tolerance policy. But take a look at the other measures of the economy, like commuter traffic. People going back to work. Here we're looking at Shanghai subway ridership, but we're also tracking using GPS satellites. What do the roads look like? What does traffic congestion look like? And they're back to year-ago levels. So they've really recovered quite a bit. People have actually gone back to work. And then finally looking at car sales. It's a big ticket item. And you got to feel pretty confident in your personal financial situation and your job to go out and buy a car. And those car sales have rebounded pretty much as well. We're hearing this from BMW, Daimler, Ford, and others, verifying this data on the ground that in fact car sales are back to about where they were a year ago. And then finally, electricity demand, here measured by coal inventories at power plants. They are back online. This is a measure of service businesses, hair salons, restaurants, turning the lights back on and welcoming customers back in. So you can see we've gone from a little bit of green at the start of the year to lots of red and orange, back to some green again in China. And these are independently verifiable data. Again, from satellites, from a European company tracking, car traffic, from, German companies with their auto sales, looking at, electricity demand, all these types of things we can verify from a third party, air pollution coming from US consulates doing air testing in Shanghai. So a lot of this data is from third parties that we can verify. We don't necessarily trusting the Chinese government to give us this. So the point of this, long story short, is we've seen a V-shaped recovery in China. And that's not the only place. We're also seeing it here in Germany. Now, Germany hit its recovery, its downturn and recovery later, right? A lot of green all the way through February into early March. They really only started to see cases begin to pick up with the lag in the second half of March, early part of April, and implemented lockdowns. And you can see that quick hit to the economy in much of April. That was really the core of the global recession. And since then, things have started to improve. People are going back to work. Manufacturing activity picked back up. Service activity. People are shopping in stores again. We're not back to the full growth situation we saw earlier this year, but we are seeing some improvement there. And that is also true here in France. And we're seeing a little bit here, even in Italy, which had a really hard time from a death standpoint. The mortality rate was much higher in Italy. People feared a much longer downturn in Italy, but even there, we're seeing an upturn in economic activity and a continued decline in the number of fatalities. Where we're not seeing a recovery as advanced is in the UK. Just not seeing it. They've had trouble getting the number of cases down, although that has dropped in recent weeks. It lingered for a long time. The UK just didn't effectively implement lockdowns. And frankly, this is what the US looks like, and what Canada looks like, and what Mexico looks like, really what all the Americas look like. So it's the UK, India, and all of the Americas that really look like we haven't quite gotten quite past we haven't really contained the virus yet, and our economies really haven't rebounded to the same degree Asia has, like Australia, New Zealand, Japan, South Korea, China, or Europe, Spain, Italy, France, Germany. We're lagging those recoveries a little bit. The risk to this recovery scenario that we're seeing in this real-time data that's now beginning to show up in some of the monthly data, and hopefully in earnings reports as we get into the next earnings season, is a second wave of the virus, shutting everything down again. That is the biggest concern I think the market's focused on just about every day. And if you look at the global perspective here, and this is tracking the global number of new cases, it looks like we're in a second wave. But I think looks are deceiving here. You definitely see that first wave here, that blue line spiking up. You can see the little ripple back in February when it was all in China. And then you see when it hit the rest of the world, particularly Europe. And the number of cases really rose in March and into April. And then it looked like we got containment there. And the number of cases started to come down. And then a whole nother second wave began. And it's really been ramping up ever since and showing no sign of slowing down. But the other line is the one I think that's more important. I'll talk about that wave in cases, but I want to talk more about deaths. That hasn't really ticked back up again. It's remained fairly contained. I mean, I don't like the fact that the line's rising at all, but the slope of that line is pretty flat. And this is really important. I think this is what dictates whether we go into a second round of lockdowns in Asia or in Europe. Remember, we have seen some. I mean, China's closed schools in Beijing this week because they had a handful of cases. But broad lockdowns across the global economy, putting us into a second recession, doesn't seem likely because this mortality isn't rising. And I think I can explain why it looks like we're getting a second wave of new cases. But let me focus on that deaths chart for a minute. Focus on that line, same line, different, got rid of the blue line, added a green one. The green one's the stock market, but it's turned upside down. So what we're seeing here with that line is when the green line's going down, actually the stock market's going up. And the reason I flipped it upside down and the scale's upside down on the left side is I want to show you how closely the stock market is tied to the deaths data, new daily death count, not the case count. We get obsessed with the case count. The case count's rising in many cases because of better testing, broader testing, but the deaths continue to remain fairly subdued. And that's really important to the stock market. But there's a risk that deaths begin to climb here. Stocks have already priced in a further decline in this death count. They're expecting it to come down. Now, hopefully, it seems that at-risk populations have taken better precautions, and we continue to see this decline even as the number of new cases goes up. But I am worried if we do see a spike in new cases, stocks are headed for more volatility, probably more declines, and maybe a retest of the lows. I'm not forecasting it. I don't even know how to forecast it, frankly, but I'm watching it very closely. And I think this is the thing to be focused on, not the cases, but the deaths. Let me talk about the cases for a minute. There are a couple of countries that are, in fact, seeing a second wave. But most of the second wave we're seeing is just a delayed first wave. It hit Asia, then it hit Europe, and now it's hitting the Americas. And what we're seeing is a huge rise in Brazil and a stubbornly high case count in the US, causing what looks like a second wave of cases, but it's really just a continuation of the first wave. But there are a couple countries in the world that are seeing a second wave. Sweden, which I mentioned, never had an official lockdown, and they're paying the price for that. And then Iran, which, well, frankly, has a host of problems. But you can see here what's happening. Focus on Spain. Definitely a second wave to the cases in Spain, but the death rate continues to decline. So Swedish stock market is not having a negative reaction to those higher cases. But in Iran, well, things are not good. And the stock market's a mess in Iran for a variety of reasons, including sanctions and falling oil prices and lots of problems. So I think it's an outlier. I don't want to draw too many conclusions from it, but clearly the rising death count there may be playing a part in the absolute just annihilation of the Iranian stock market. Not that I think it's a reliable indicator anyway, but that's really the outlier. For the most part, even when we're seeing a second wave, the number of deaths is coming down. Let's focus on the US for a second, as it gets a lot of attention, and I want to focus on here. So I've talked a lot about the globe. Let's focus on the US. Take a look at this. We're starting to see a little bit of a rise in the number of cases. Now, that's a number of states really seeing a continuation of their first wave rather than a second wave, although some states arguably could be seeing a second wave. But focus on the other line, the mortality line. It continues to fall. Critically important to the US stock market that continues to go down. That's what I want you to focus on, not the case count, the death count. It's morbid, it's sad, the human toll is immeasurable. But from an investment perspective, and that's what I'm charged with doing, figuring out what this means for markets, that's the line you want to focus on, and we hope and pray it continues to come down. Now, let me turn the attention a little bit to where we're hearing about second waves, and then I want to get into policy and a number of other things. So this is the last thing on the virus. But ripples is all we're seeing in China and Korea. They've gotten a lot of attention lately. We're seeing a second wave. We've shut down schools or we've shut down some businesses. But look, I mean, it's barely even, you can barely even see it on the chart. China had a day where they had 50 new cases. Well, that compares to 3,000 cases or more, arguably back at the peak where they weren't even measuring cases in Hubei provinces around the city of Wuhan because they had locked it down and couldn't. So it's a ripple. And there'll continue to be ripples. And we might even get, larger ripples in the fall, when we usually see viruses pick back up again, like the common cold. But, right now, this is the first week of winter in Australia and New Zealand. No second wave. I mean, New Zealand last week actually even got rid of social distancing. Forget it. No masks, no social distancing. Everything's open, totally back to normal in New Zealand. And the number of cases, 0, 0, 0 every day. So hopefully, what that tells me is we don't necessarily have to fear the fall or the return of winter. If we've taken the proper precautions and really done a good job in containing the spread, then maybe things can get back to normal and they'll just be ripples and not truly a second wave. I'm not forecasting that. I'm not an epidemiologist. I don't know. I'm focusing on the data, and that's what the data is telling me as I look around the world. So enough on the virus. I think it's critically important as Hillel set up, but let's talk about the policy response. The guardians of the economy have done their job. Yep, the market loves it when the Fed comes in. Here's Jerome Powell at the Fed, Jay Powell. We've got, of course, Christine Lagarde at the ECB, Kuroda at the Bank of Japan, of course, Bank of England's Carney, have all done everything they can do to make this an easier time for all of us. Crossing a number of red lines in terms of the Fed actually, buying corporate bonds, the European Central Bank providing essentially common fiscal policy, or allowing a basis for common fiscal policy in the Eurozone. It's amazing things happening here that we've never seen before taking place, an incredible amount of stimulus. And when you combine that with fiscal stimulus, it's absolutely jaw-dropping. So just putting this in perspective, we used to talk about a 3 or 4% boost to GDP in a country as a very big stimulus program. Take a look at Japan. Yeah, 60%. That's not a misprint. 60% of GDP. Take a look at the US. 43% of GDP between monetary and fiscal stimulus, and the same thing in the Eurozone. Although interestingly, a different mix. In the US, the mix has been more focused on monetary stimulus. In Europe, it's been a bit more on fiscal stimulus. And that might mean different things down the road, interestingly, as it relates to their economies. And I'm actually more in favor of fiscal than monetary stimulus here. I think it's more effective. And that's kind of interesting. But China as well, the UK hasn't done as much. I think they will continue to do more. Absolutely 28% of global GDP. We've never seen anything close to this. The global response to the global financial crisis was single digits, mid-single digit boost to global GDP. So this is 5-6 times bigger than that and delivered in a far shorter amount of time. So wow is all I can say to this. It's one of the reasons why April is probably the bottom of the recession and we're already in a recovery. In large part because this was directly injected into the economy in the areas that needed it most, right? Workers who needed support, small businesses that needed support, really effective and delivered right away. What's the hangover? Not that this is a party by any means, but what's the hangover from all this stimulus? Well, we might need to deal with that in 2021 and beyond in terms of a maybe more lackluster recovery. But right now, that's not the case. The recovery is absolutely full speed and V-shaped. We'll see what the shape looks like next year. There might be, again, a price to pay, but right now, pretty powerful rebound we're seeing in the data. I think in direct response to what we're seeing in terms of government stimulus, which has been effective, coordinated across party lines, coordinated across country lines in a way you will only get with a crisis. So what's this mean to us as investors? Well, let's take a look at what the market's doing. This has been a very different recovery so far, but it's starting to look a little bit more normal. But I think it's still going to catch investors by surprise. Not the recovery itself, but the stocks that are leading it. So what we've seen off of the lows was very different leadership. Usually you get economically sensitive stocks leading the economic recovery. Totally makes sense, right? So we look back here to the recovery back in 2002, from the 2000, 2001, 2002 tech wreck, global recession. It was economically sensitive stocks that began to rebound. And the same thing was true coming off of the 08-09 bottom. Those stocks were hit the worst and they rebounded the most. This time, that wasn't the case. The stocks that began to lead the recovery in the first 25-30% of this rebound were defensive stocks, meaning stocks that tend to do well when the economy's weak. The market was recovering, but what it was pricing in terms of a recovery was long and slow. So we saw healthcare as one of the best performing sectors. We saw parts of the tech sector like Zoom do really well on the idea that we're all going to be working from home for the rest of our lives. And that's what was leading the market rebound. But that has started to change. In the last month or so, we've seen cyclical stocks begin to assert their leadership. Value stocks, even financial stocks, have started to outperform. These are stocks that haven't performed in a long time, are starting to lead the market higher. And one of the other things that comes along with this is international stock market leadership. generally non-US companies are more economically sensitive than US companies. I mean, in the US, we've got a lot of healthcare and a lot of technology, and they tend to be a little less economically sensitive. We consume a lot of tech, whether things are booming or not. We consume our pharmaceutical products. We take our drugs, whether things are booming or not. But outside the US, there's a lot more economic sensitivity. And so we're actually starting to see in this month and last month, international stocks are outperforming. Emerging market stocks are beginning to outperform. Most investors aren't prepared for this. Most investors, without the benefit of a plan and market investing wisdom, tend to just follow their own whims. And what's been working for the last 10 or 12 years? US stocks, tech stocks. And that's where their portfolios are focused. And we see it at Schwab. When we look across individual investor portfolios, all they own are these FANG companies. And you know what? They haven't been performing that well lately. The tech sector has actually lagged this month. It's done okay yesterday, did okay today, but it's lagging this month as new leadership starts to emerge. This is always the case with the new cycle. New types of stocks tend to lead every cycle. It's not the old leaders. And this is what trips up a lot of investors. They think the old leaders are going to come back. Whatever was leading in the last cycle, they hold on to them through the downturn, thinking, yep, they're the ones that are going to rebound the hardest. And they never do. The old leaders are never the new leaders. So I want to talk to you about what those new leaders are and what I think most investors are probably missing right now. It doesn't matter whether you missed getting out of the market or getting back into the market. I think this is the bigger risk for investors. I think just staying allocated through this and keeping a balanced portfolio through all this was very smart with how much the market has pulled back and then rebounded. I think the key this time is making sure you have broad global exposure across styles and capitalization. So enough setup. What do I really mean? This is what I'm talking about and why I'm talking about it. It starts with the yield curve. You may have heard about the yield curve. I talk about it all the time. It's my favorite economic and market indicator, but I'll briefly take you through this since it's already done its indicating. And that's the blue line across the bottom of this chart. It's a simple measure of long-term versus short-term interest rates, long-term minus short-term interest rates. Why do I do that? Because whenever we've seen long-term interest rates fall below short-term interest rates, which is very rare, it's a signal. It's a signal of an imbalance in the economy, that there's not a lot of demand by businesses for long-term borrowing, but things are heating up in the short term. And whenever that's happened, I've marked it with an orange dot on this chart. Whenever that line's dropped below zero, meaning the long-term rates have dropped below short-term rates. And they're usually about a year before those gray columns, which you remember from my very first chart, were recessions. So it's a good indicator that a recession might be coming. And sure enough, it was a good indicator this time. I haven't shaded the recession yet on this chart. But more important than that, is it's a sign that a change is coming in market leadership. And so when the yield curve inverted last summer, we were a little worried about the economy slowing, as I pointed out in that first chart, heading into a recession, but even more importantly, that new leadership might emerge that investors weren't ready for. And here's what that looks like. So what I've done here is shown you growth and value stocks, two different styles of investing. Growth stocks, well, a classic growth stock is really any tech stock, right? They grow very quickly. Earnings are soaring, but they're very expensive to buy. The stocks are priced very expensively. Value stocks are the exact opposite. They tend not to grow very quickly, but they tend to trade at very cheap prices. And different styles tend to favor, or different cycles tend to favor different styles of investing. And that's what you see here. The blue line going up is when growth stocks are in favor. Boy, we saw that in the 1990s. Tech stocks took off, the big dot-com boom. And being in growth stocks was where it was all about until we hit that blue column there. And that's when we got that yield curve inversion where long-term rates drop below short-term rates, signaling a change in the cycle was coming and a recession was right around the corner. So that peaked right there in 2000. And sure enough, that's where we saw a shift. And value stocks, the orange line, began to rise, led by financials, the classic value sector. And throughout the first part of the 2000s, from 2000 to 2007, value stocks were where it was. Tech stocks underperformed, financial stocks took off, all the way until really right around the beginning of 07. Now, the recession didn't begin till 08, and stocks didn't really peak out to the end of 07, but we started to see a shift in leadership in the markets back to growth stocks, led once again by technology. And sure enough, from about 2007 all the way through to the beginning of this year, Tech stocks were the place to be. Growth stocks were really the leaders. And even through that yield curve inversion and the start of the recession, well, tech performed pretty well because it was a little bit defensive, but we've started to see that begin to reverse. Tech has been underperforming this month, and value stocks have started to show some leadership. This isn't just about the next few weeks or months. I think this is this whole next cycle, which could be 5 or even 10 years. We see new leadership, value stocks coming back and leading the market. So critically important to rebalance portfolios, stick to the plan, right? Rebalance back to those long-term targets of a balance between growth and value, and not be too overweight growth and tech stocks here, even though it's very easy to be given their incredible performance over the last cycle. So let me show you what this means in 2 other ways. Same looking chart, but this time large and small company stocks. Now, what you'll notice here is that the blue line rising is large companies outperforming. The orange line is smaller companies. And we've seen these reversals again and again and again. And here we saw the reversal again this time, just ahead of the inversion. We started to see larger companies begin to outperform. And that's even continued here lately through this incredible volatility. We've seen this trend begin to emerge where larger companies are starting to outperform smaller companies. Again, I don't think this is just for the next week or 2 or month or 2. I think it's for the next 5 or 10 years, we start to see larger companies play out. And by the way, why does this work? Why do these reversals happen? Because at the end of a cycle, expectations get a little out of alignment. I'll go back to growth and value. Growth stocks, just their valuations get very stretched relative to value stocks, sometimes for good reasons. But those expectations as we go through a downturn get reset. They get reset for the entire stock market, value and growth alike. But wherever expectations are highest, they get reset the most. And that resetting tends to lead to the laggards starting to outperform in style and here in capitalization, and then finally in geography as well. And that's the last chart here. This rotation, I think, back towards international stocks after a decade of US stock outperformance. Now, you'll see I added another 10 years. I had to go back a little further in time on this chart to a period where international stocks outperformed by as much as US stocks outperformed international stocks over the last 10 or 12 years. And to see that, you had to go back to the 80s. And that's that blue line soaring there throughout the 80s, really led by Japan, when Japan was going to take over the world. And the Nikkei and gosh, even real estate in Tokyo just absolutely soared relative to the US. And that peaked in 1989 with the yield curve inversion and the 1990 recession. And we saw that begin to slam closed. International stocks began to underperform and US stocks began to outperform. And it reversed again and again. And really for the last 10, 12 years, US stocks have been the place to be and international stocks have really lagged. I think that's about to reverse. And in fact, in the last month or 2 has started to reverse. This, of all the things I've talked about, this catches most investors by surprise. I've talked to thousands of investors digitally like this and in other ways since we've entered into this downturn, and they are shocked that international stocks are leading the recovery. They can't believe it because they just haven't seen it. There's a whole generation of investors that have never seen international stocks outperform the US. They just didn't know it could happen. and I think not only is this happening right now for good reason, it's not a fluke, I think it could happen for the next 5 or 10 years. This is probably the area where most investors are completely blindsided in their portfolios. If they haven't had the benefit of advice or a plan, they've simply let the international portion of their allocation drop to 0 or aggressively drove it there, including emerging market exposure. And those areas have really been outperforming lately. So a balance in your portfolio tied to a plan, critically important here. And the benefit of that plan really beginning to pay off here in recent months, and it will really begin to pay off over the next few years. And looking back and understanding why we had a plan and an asset allocation in place that favored these or included these asset classes going to be increasingly obvious, I think, as time goes on. So I know I talked a lot. Let me just sum all this up. Watch new case growth, but really watch the death count. I know it's morbid, but that's really what the stock market's tied to. And the risk is if that starts to go up, not the cases, the death count, I think stocks are at risk of another dip. Hopefully we don't see that. And again, I'm encouraged by what I'm seeing in countries that have fully reopened, like New Zealand, like Australia, that have not seen a revival in cases, despite the fact that it's a return to winter there. expect some volatility. The markets have priced in a recovery. Now it's where that recovery may get a little bumpy. We've seen a V-shaped recovery in many of the countries around the world. Does that continue, or does that begin to slow? I think that fades a little bit in the months ahead as we get this pent-up demand rebound off the lows. That doesn't mean we see a return to recession. It just means it slows a little bit, and markets have the possibility for disappointment. So some volatility. Again, a good plan, asset allocation can manage that. And then watch out for the reversal in these long-term trends in the markets. I think it's the thing that's going to surprise people the most. It's not the old leaders that lead in a new cycle. It's always new leadership. And again, I think you're well prepared for that if you have a globally diversified asset allocation. And I think that's going to begin to pay off. So let me stop there. Welcome your questions, comments on anything I talked about or anything I didn't. There's certainly a lot going on. Of course, we've got an election this year and so many other things. So let me get back to the video. And
That's great. Well, that was a very big picture assessment of what's going on. Obviously, the virus is going to determine how the economy plays out. I mean, that's understood, and I know that a lot of companies are working very hard on finding a vaccine, and I think that's also a reason that the stock market, which is kind of a reflection of what's going on and the anticipation, is they're anticipating that there'd be not only a recovery by way of this change from growth to value and change from tech, perhaps in the United States, to international, so it shifts the leadership, but also the fact that, God willing, there'll be a vaccine, and we can't bank on that right now, but I think there are 120 or 140 companies that are very hard at work. It might take a year or two, and that's always this uncertainty. So I'm just reflecting back to you, Jeff. I thank you very much for your comprehensive review. It seems to me that, international, which has lagged for a long time, people have somewhat ignored it. I'm glad you obviously mentioned that's in your portfolio to talk about, because we do include in our model portfolios international developed market and emerging markets, and depending on the risk tolerance of our clients, we have incremental increases in those positions, as well as value and growth. And talking about risk, the way we try to assess a client's risk is to go through a risk questionnaire and to talk to them and try to listen as far as what their experiences are in terms of their investments. And we're now understanding that risk tolerance is really something that's more than just quantitative. We understand that it also is qualitative, and that we have biases. And I'm kind of reflecting back to you, but the bias towards domestic, home base, home country bias is very overwhelming. And in fact, in most of my clients' portfolios, US is clearly the dominant, and probably for good reason. It is still the largest economy, and there's a lot of diverse companies to invest in. But when it comes to international, maybe you can share, how does the risk on investing in international companies balance the risk that is in domestic? How does that work?
Yeah, a good question. And I'll just reflect first on the home bias. Everywhere I go, everywhere we have Schwab clients, there's a home bias. So when I go to Asia, when I go to Hong Kong, often 80% of the portfolio, I'll just ask, hey, what percent of your portfolio is in Hong Kong stocks? 80% of their portfolio. When we go to London, it's 80% of the, 75, 80% of their portfolio in UK stocks. I've been to Greece, like 70% of their portfolios in Greek stocks. This is not a good idea, people, but we do it. We all do it. Even when your home country isn't the biggest economy in the world. I guess we're just more comfortable with the local environment, the local companies. We know them. We feel more comfortable with them. But the risk is that we miss some opportunities. And it's not that the customer base is different. It's not that the U.S. economy is growing faster, and so we should invest there. Remember, Toyota, sells to the same global marketplace as Ford does, but it's an international company and it's valued differently as a result of that. I can tell you that Coca-Cola and Nestle have the exact same geographic distribution of their revenues. They literally get to a percentage point, the exact same amount of money across continents of the world. They both sell beverages and snacks to the same people everywhere. Yet one is valued differently in the US markets than another one, simply because the investor base is so different. So while certainly there are currency differences, there are some political differences that have an impact, tax regime, but for the most part, they're really selling to the same customer base, and they're operating in a global way, so they're really touched by the same trade, political, and tax risks. It really comes down to how the investors in those stocks value them. So right now, a U.S.-based company that sells to the same customers versus a European-based company that sells to the same customers are valued dramatically differently. Sometimes it flips like this, but right now the US company is valued much more highly for the same earnings, the same growth than the international company is. So I really don't see dramatic differences in the risk profile. I think where the risk is, the expectations for growth are much higher in the US based company, even though the customers are the same, than the international one. And that isn't always the case, but it's been at an extreme, and those extremes usually correct themselves over a number of years. And I think we're at that point where that starts to correct.
Very good explanation. What about other kinds of risk? I know that we have an election year this year. Is that going to be pivotal in who is going to be occupying the White House next year, or will it be immaterial? And what factor does that have in your equation when it comes to your advice, as you're suggesting, broad diversification and asset allocation?
We spend a lot of time, and we have a number of people in Washington, D.C., completely dedicated to understanding the policy environment. But I think we often get it backwards. What happens in the markets and the economy between now and the election is going to have more of an impact on the election than the election outcome is going to have on the economy and markets, right? So a lot of, I think people thinking, what should I do now in the market to prepare for the election? But really, the market's going to be driven by the viruses and the economy, and then that's going to shape the election outcome. The election outcome could subsequently then have an impact on the markets, but really it's backwards if you put the election before that stuff first. So I think that's important. But as I look at the potential where you could have some sweeping change would be, if we did see a Democratic wave that took not just the White House and retained the House of Representatives, but took the Senate as well. If Biden wins the White House, they only need 3 seats to essentially, control the Senate. And that could mean sweeping changes to the energy sector, the healthcare sector, financial services, areas that are very legislatively oriented. But the market's not responding to that at all. As a matter of fact, one of the areas that's more policy, has a number of policy risks right now is the tech sector. This week, in fact, the second half of this week, we've seen new legislation introduced to kind of take away some of the protections of the tech sector in the U.S. We've seen immigration controls put in place or proposed that are particularly negative for the tech sector. It's dependent on that foreign talent. And then we've had a European digital tax be advanced a little further. All these things are negative for the tech sector, yet tech has actually outperformed yesterday and today. On a down day yesterday and an update today. So kind of interesting to see that backdrop. I don't think policy risks are driving the market at all right now. That could change come October, but right now it's much more driven by what's going on in the markets or what's going on with the economy than what's going on with the election.
Changing gears a little bit, we're talking about interest rates and interest rates being so low, where people are looking for income and yield. Also coupling that kind of conversation with this tremendous amount of fiscal and monetary stimulus and the potential effect that might have on inflation. I've heard that that's a possibility. Can you address those two questions?
Yes, we do see inflation rising over the next year, but not in a particularly devastating way. So right now, inflation's running at like 0.5%. That could tick up to maybe 1.5%. It could push bond yields higher, maybe to 1%, maybe even a little bit higher towards the end of this year or into next year on the 10-year, but still relatively low. And so, we still view high quality corporate bonds as a pretty attractive place to be from a fixed income perspective. Municipal bonds, general obligation municipal bonds still seem pretty attractive. They're not offering a lot of yield, but enough that the rise in interest rates that we expect over the remainder of this year and into next year, not quite enough to erode the income gains. And of course, were stocks to retreat again, that fixed income is going to provide a nice cushion there. So it's a little bit of an insurance policy against a return to recession, and one that probably will at least result in just maybe modest gains, income-based gains over the course of the next year, given our outlook for where interest rates go. I think a bigger question might be what happens with the dollar. If we continue to see a decline in the dollar, then international fixed income may look increasingly attractive. Yields there are even lower than they are in the US, thanks to negative sovereign yields. But when you take a look at that currency, the dollar's dropped about 3% over the last few months. If we were to see that repeat, let's say over the next year, then international fixed income begins to look more attractive relative to the US. So right now we think broad exposure is good. More across more asset classes is better than concentrating, but that can become an area we become increasingly attracted to if the dollar shows further weakness tied to the incredible, more monetary focus of stimulus in the US.
Jeff, thank you so much. We're coming up to the top of the hour. I just want to share my screen this was the agenda that I forgot to put up while we were organizing, but we looks like we accomplished everything. And I just want to thank Jeffrey and Heather O'Leary, his support, and his partner, and what a great team they make. And I also want to thank Lily for helping me put today's presentation together. Next month, we've got a very important educational event, cybersecurity and ID theft. And I'm sure, Jeffrey, you're aware that because of COVID, scammers are going full out for people that are going onto those maps, because everybody's focused and fixated on the number of infections and deaths, and that's just where the scammers are hiding and waiting to pounce. So we hope to have an FBI agent to do a presentation, and I'm sure it will be informative. If it's not an FBI agent, we'll find the appropriate person. I did put in the chat box a feedback survey. If you would just take a minute or two to do that, that would be appreciated. We can email it to you as well. I just want to thank again Jeffrey, for your insight, for your knowledge, for your sharing your wisdom, and thank everybody for attending and taking the time. I hope everyone has a wonderful day, and please stay safe and stay healthy.
Thank you all very much.
Thank you. Bye-bye.